Imagine opening your brokerage app and realizing that 7 stocks now decide whether the entire market has a good day or a bad one. Not sectors, not industries. 7 names. If they go up, headlines celebrate a bull market. If they slip, trillions quietly evaporate. This has happened before, and the last time it didn't end gently. Right now, a tiny group of companies carries an absurd amount of weight. Apple, Microsoft, Nvidia, Amazon, Alphabet, Meta, Tesla. Together, they're often called the Magnificent Seven, a flattering name, almost mythological. But market history has a habit of humbling myths. Here's why this matters right now. If you own an index fund, a retirement account, or anything that tracks the market, you are not broadly diversified the way you think. You're heavily exposed to the fortunes of a very small club. Whether you like it or not, your financial future is leaning on the same narrow pillar. To understand why that's risky, we need to rewind. In the late 1990s, the market told a very similar story. Back then, it wasn't 7 stocks. It was a handful of tech darlings that couldn't lose. Cisco, Intel, Microsoft, AOL. They weren't just successful companies. They were destiny. Every index fund kept buying them. Every analyst had a price target that went up. Every dip was a once-in-a-lifetime opportunity. Sound familiar? Here's the part people forget. The problem wasn't that these companies were fake. Most of them were real businesses with real revenue. The problem was math. Indexes don't care about fairness or balance. They care about size. The bigger a company's market value gets, the more of it the index must own. When a stock goes up, the index buys more of it. When it falls, the index sells. It's momentum disguised as diversification. So as tech stocks surged in the late 90s, they quietly took over the market. A small group ended up driving most of the gains. The market looked strong, but underneath it was dangerously narrow. Then growth slowed. Not collapsed, not vanished, just slowed. And that was enough. When expectations are extreme, pretty good feels like failure. Valuations compressed, stocks fell. And because those few companies had grown so large, their decline dragged the entire market down with them. The Nasdaq lost nearly 80%. The S&P 500 took years to recover. Many of the companies survived, investors didn't. Now, fast forward to today. The Magnificent Seven are extraordinary businesses, no question. They dominate cloud computing, AI, digital advertising, consumer hardware, logistics, and electric vehicles. They print cash. But here's the uncomfortable number. At various points recently, these 7 stocks have accounted for roughly 30% of the S&P 500's total value. In some months, they've driven nearly all of the index's gains. Strip them out, and the booming market suddenly looks average, sometimes worse. This is where the story gets tricky, because nothing has gone obviously wrong. Earnings are strong, margins are high, balance sheets are clean, which is exactly how concentration risk sneaks in. It doesn't announce itself with panic. It arrives quietly, wearing confidence. There's also a subtle illusion at work. When headlines say the market is up, what they often mean is these 7 stocks are up. The other 493 companies are just there, flat, lagging, occasionally struggling. That's not a healthy market. That's a top-heavy one. And history is ruthless with top-heavy systems. The irony is that the biggest risk isn't collapse, it's disappointment. If AI growth slows by a year, if regulation tightens, if profit margins peak instead of expanding forever, nothing catastrophic has to happen. Stocks priced for perfection don't need bad news to fall. They just need less good news than expected. And when 7 stocks hold the steering wheel, a small turn feels like a swerve. There's also a feedback loop most investors never see. As money flows into passive funds, those funds automatically buy more of the biggest stocks. That pushes prices higher, which increases their weight, which attracts more money, which buys more shares. It feels stable, until it isn't. This is not a prediction of doom. Markets don't repeat perfectly, but they do rhyme. In the past, concentration always felt justified at the time. Railroads, oil, Nifty 50 blue chips, .com tech, Each era had a reason why this time is different. Each era had brilliant companies. Each era ended with investors relearning an old lesson. Dominance is not the same thing as safety. So zoom out. Ask a simple question. If the next decade is slightly less magical than the last one, if growth becomes merely strong instead of legendary, if innovation continues but valuations don't keep up, what happens to a market built on 7 pillars? Do they quietly deflate while the other market catches up? Or do they take the index with them? That's the unresolved part, because the risk isn't obvious. It's structural, and the market doesn't warn you before it tests structures like this one. It just waits.